Hello, this is Ron Janish, and this is Introduction to the Advanced Andrews course. What we're going to do is we're going to show you how Andrews works. And this is very different from this stuff that's out there where they show you, gee, draw a median line, and this is some really cool stuff. So what we're looking for are 5 different things, really. First thing we look for is a setup. And then after we have a setup, we're looking for a trigger that triggers the entry. And then we're looking for what to expect, because if things aren't within what we expect, we probably want to get out. Don't take on any additional risk, because remember, trading is risky. And then how to figure out a target area, which is really easy. And then there's exit, exit, exit. Okay, so let's get started. Let's see just some typical examples. This chart you see in front of you here is nothing more than a 60-minute chart from ES, so that we know it's not something that's manipulated by someone. But this is a recent 60-minute chart, and here is up here, I just stuck a little label up here. The pattern, I call it EZ, and this is what I consider to be a setup, as mentioned up here, that I consider just very, very easy, and we'll label it easy. And this is a setup that comes up a lot of times. And down here is a setup we call the ORE, and this is what Andrews considered to be his setup slash trigger, which really was combined. That was the most powerful thing he ever saw at finding the ends of corrections. Okay, so easy is good for the end of a move, and ORE is really focused on the ends of corrections. Okay, let's move on. This is the same chart that we saw here. Here we see EZ, ORE, and here we see ORE and the next EZ, and the next EZ, and the next EZ. Okay? And this was very, very recent. I'm looking here at this was around the 18th of November. Okay, so this was a few days back. Okay, so remember, what we're looking for is a setup. We're looking for a trigger. Then we want to know what to expect, and then we want to have an idea as to the target area, and then exit, exit, exit. Okay, so let's start here. This here is a chart that's pretty well known, discussed on TV all the time. This is an Apple chart, and when the price of Apple was up here in this area up here, what we did was we looked at this and said, hey, this is what we'll call an EZ pattern. Okay, and those of you that are advanced course members can look at this and say, oh yeah, well, that's easy to see, right? And so what you have here is you have the setup, and then what you're looking for is a trigger. And this here was a chart that I sent out at the time for those of us that are in the Advanced Andrews group that were following this stock, and some of them were, and like good old John down in Australia, he loves this Apple stock. And so I sent out this particular chart because I noticed that in addition to there being a setup, this easy setup up here, we also had what I consider a trigger. And a trigger is very often when prices go and bounce off a few lines. Okay, and they're usually very specific, but in this particular situation here, all you really see is that prices went to the intersection of a couple of lines, and that coincidentally happens to be there in many cases. This pattern here, by the way, is nothing more than a blown up pattern of this here, a blown up chart of this here. And it is so what we're doing is we're taking the daily chart and blowing it up with maybe 60 or 120 minute bars, something like that. And then so that at this point in time, there was an expectation that prices would not spend much time over this line here and go down, which they were very nice and cooperative, and they did. So what happens is, now remember with Andrews we're looking for the setup, the trigger, and then we're looking for what to expect. Well, one of the things that I discuss that's really kind of handy for what to expect is something I call the Babson profit ladder. And the Babson profit ladder is something you can use and project out into the future. So when you have, let's say, this much data here, you can project the next two rungs of the ladder. Now, what good is it drawing this kind of a thing, right? This weird looking thing here. Well, let me clue you in. This cute little thing here, when prices went down to this point here, they bounced off of here, and or in this area. They don't do it absolutely perfectly, but these ladder points give you an idea as to approximately where you will get support and resistance. Why is this important? Well, there are those that like to trade intraday. And so for somebody who's an intraday trader would use these points here as something that would alert them, in other words a setup, and then they would use something else that's more of an intraday type chart in order to find a trigger, right? So let's see what actually happened. Okay, so if you look here, look at this, beautiful, beautiful. They'd go past the ladder and then up to it, and we can see that in so many cases they would simply, like here once again, they broke through the ladder and up again, and we can see in so many cases they would simply use this here as support and resistance. And as you can very clearly see here, they have now stopped using it as support and resistance because they just blasted through they reversed at a ladder point and then blasted through the prior one, which typically tells me that the ladder is over. Okay, so this gives me an idea of what to expect, and that might be what I use. And I also use other things, but this is one of the more intricate tools that are used. Okay, and so in future advanced course lessons that you can take, you'll learn various setups, various triggers, and most importantly, matching those properly. What we found in our research, which setups go with which triggers. Okay, and we're constantly doing various types of research. I'm going to show you some ongoing research right now. I'm doing something called a G-spot, and so what happens is we'll do parallel trading, parallel real-time trading in different systems that we're testing out. And so here we're using stocks. Why do we use stocks? Well, because stocks, there's just lots of them, and they give us lots of setups and triggers and stuff like that. And so what we did was at the beginning, about the 8th of November, and so we're in it now 12 days in this particular test. We started this test here, and we've got lots of nice green and stuff, and that's pretty, and it's up and profitable. Let's see if we do an F5. Boom. And there's a good reason why we call this G-spot, and here we go. So it's up a little bit. We started with the parallel account started with 250. In the last 12 days, it's up 4. And what we do in our historical tests, our historical studies, is we use longs and shorts. And the reason is because Andrews taught that going long, going short, they're pretty much the same thing in terms of finding triggers and setups and that kind of thing. So what we're doing in this particular test is we're testing out to see if the exact same combination of trigger and setup works well together over a period of time. And what's nice is in stocks, when we do a historical test like this in stocks, we'll be able to see at the end of probably a month or two how well it works, and we'll be able to develop a chart that tells us what percentage winners, what percentage losers, things like that, that a particular combination of setup and trigger gets. Okay, and so these are the things that we show you, and we do the historical studies on that. Okay, now I'm going to give you an example of of an actual setup, trigger, and we'll take a look at those 5 steps. Okay, so here's one of the things that I wrote about years and years and years ago in Technical Analysis of Stocks and Commodities magazine is zoom theory, and simply says that after prices zoom through an ML, which they did here, here's your median line, here's your high, low, high, they zoom through the median line, and then they typically retrace back and then go further in the original direction. Now, obviously, this was a failure, and so Andrew's theory was that when his rules would fail, the failure of a rule would be just as significant as the rule itself. So here you have prices coming down and they fail, okay, and so they fail to go and make new lows here, right, past this previous zoom point, and the theory is that they would then go up in this new direction. Right? Well, there's another theory that Andrews taught, and that was something called Hagopian's rule. And Hagopian's rule was simply that when prices fail to make it to a median line, like they failed to make it here, to this median line here, they would go lots more in the opposite direction. Okay, that's Hagopian's rule. So if Hagopian's rule is the setup, and zoom failure is the setup, so here we have 2 setups together, okay? Then you use something for an entry. Now, under standard Hagopian's rule, the entry is, in this particular case, would be a break of the H, which is the parallel line to the median line, and so it would have gone long on this day here. So the thing here, and by the way, this chart here is a bond chart of the 20-year Treasury. It's kind of an ETF, okay? And so yes, that's what it did. And so if you had your trigger here, okay, down here, and then had your move this way, with standard Andrews rules, you would have gotten in right around here because of Hagopian's rule, for example. Okay. Now, with advanced Andrews rules, you also would have gotten in, but if you look at this chart here where you have this nice move upward, you also, those of you that are advanced course members, can open up your manual to the second to last chapter and notice the standard Andrews trigger entry on this chart, right? Which would have gotten you in before those people who took advantage of Hagopian's rule, right? And so you have this nice little move up here, and so where does your target come in? Your target is this median line. Andrews would say, well, this is a target, and the target is really not a place where you would necessarily reverse. You may, but it's not necessarily a reversal point. And this is just to get, the target is to give you an idea of about where prices are headed. And what Andrews taught is that 80% of the time prices make it to the median line, right? Okay, so here's what actually happened. Prices went, and this is the profit ladder. Once again, we draw the profit ladder. This is the Babson thing. Okay, and so prices go up here, and they go up and down, up and down, up and down. Probably gives some people a headache. And as they get up to here, they stop, or they go right up to this third reaction line, right? And you also happen to have an easy pattern up here. So this is probably a great point to exit, 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 right? And this is what happened afterwards. We can see this now with perfect 20/20 hindsight, right? So remember, your future lessons in the advanced course consist of videos, over 20 some odd videos that cover the various things that you need to understand in detail. And with that, you get various setups, various triggers, which setups go with which triggers from my experience. And since you'll know what the setups and triggers are, you can mix and match and see what it is that you prefer depending upon your risk profile. Okay, so all you do in order to get started and participate is you go to andrewscourse.com, okay, and you click on products and click on buy now, and there you are. You even get our PT3 software as a gift to you, and just for the asking, you don't even need to, if you just send me an email, I'll tell you how to do it, how you can get commodities data. If you wanted commodities data, for example, and not have to pay all these incredible exchange fees, okay, there's a workaround for that, and it's really kind of cool, and I will show you how that's done. And you just email me at ronj@san.rr.com. This is what we do. Anytime I want commodities data, I can get it without paying the incredible exchange fees, right? Which, if you follow futures on the CME and CBOT and stuff like that, that can be hundreds every month, and there's a very easy workaround for that. So, and it isn't this deal with one company where you have to make a whole bunch of commissions and trading and all that kind of stuff. You can be trading zip or very little and still get this, still get the full benefit. And we'll be glad to tell you about that. And if you're and so as a member of the Advanced Andrews course group, one of the huge benefits is that you get to be a member of our email group, and so you wind up getting the real-time emails and the pretty little pictures, charts and stuff that I sent out. Like, for example, when Apple was up here, this is one I sent out, right? So so if you were following Apple, that would get your attention and you would examine that further, right? And so, for example, another example is recently prices were down here, and at approximately this point here, which would have been, yeah, about 9:30 in the morning on the 16th. Let's take a look. Sent. Let's look at this. Let's find the date. Let's look at November 16th. In the morning. And here's where Matt and I were going back and forth. Yeah. About the pattern in the ES. So give you an idea. And this also went out to the Precision Trader group and the Advanced Andrews group. It goes to people that are in the advanced group directly. So it says here we go. You say I'll be watching for the golden pivot rule. It's much better here at catching the low. So this is the kind of simple, straightforward discussion that we have in our advanced group, and I invite you to come and join us, and you can see the fruits of my research and go from there. So just come over to Advanced Andrews course. You can use your Visa MasterCard. If you want to send a check, you're welcome to send a check. Just let me know on the email. Send me an email and I'll give you the address to send a check to the corporation, so you have a nice record of what it is you did for tax purposes. And I thank you for your time, and this is Ron Janish signing off. See you next time.